It's hard to believe it's already December and Christmas is around the corner, especially when you live in California. But it is a good time to consider doing a Roth conversion. A Roth conversion is when you take your traditional retirement accounts and you convert them into Roth accounts. A traditional account, as you might recall, is an account where you funded it with money for which you took a tax deduction. The money grows tax deferred, and when you start taking money at the retirement, then you will be paying ordinary tax on the withdrawals. Oh, my favorite, ducks again. With Roth IRA accounts, it's different. You are not benefiting from your contributions to those accounts when you make the contributions. However, the money grows tax deferred and tax free. You will never be taxed on it again when you start taking the money out. Why would you want to convert your traditional accounts into Roth? One of the reasons could be that maybe this year you are in a lower tax bracket than you predicted to be in the following years. Another reason could be that your account is down, and whatever you transfer to a Roth account, you're taxed on that value. So not on the entire account, but only on the amount of money that you're converting. So let's say your account was earlier in a year worth $50,000, your traditional account, now it's worth $40,000. Maybe you predict that it will be growing exponentially in the coming years. So it might be wise to convert it now, pay the tax on that conversion, and then have that money tax-free later on. Another reason why some people like to convert the money from traditional to Roth is that there won't be any required minimum distributions later on. And required minimum distributions are a little bit tricky because they are added, the money that you take out as a required minimum distribution, increase your adjusted gross income. And as we know, adjusted gross income can impact your premiums for Medicare, can also impact the deductibility of your state and local tax. So maybe you want to protect yourself from being forced to add additional money to your adjusted gross income and take the money today. It works also the other way. When you take the money today, when you convert from a traditional IRA to Roth, that money will be added to your gross income for the year. And so we have to see if that makes sense, because maybe you will be over the threshold for taking the entire state and local tax deduction of $40,000 this year. Or maybe that conversion will put you over the threshold for Medicare Plan B standard premiums. Lots to consider before you pull the trigger, but if you are planning on making the Roth conversion, that would have to be done before the end of the year if you want it to count for this year. That's a little bit different than original contribution to IRA accounts, because original contribution to IRA accounts, either Roth or traditional, can be made by April 15 of the following year. However, when we talk about Roth conversions, those have to be done before the end of the year. That's all I have for you today. Until next time.